This is the Brave New Coin Crypto Conversation, hosted by Andy Pickering.
Hi everyone, Andy Pickering here. I'm your host and welcome to the Crypto Conversation, a Brave New Coin podcast where we talk to the people building the future in the Bitcoin, blockchain and cryptocurrency space. My guest today is Joshua Scigala. Joshua is the founder of the Standard. Standard is pretty interesting. One way of describing it is as a next generation monetary system that enables users to generate or mint a stable coin, really, called the Standard Euro by locking up their crypto or even physical gold to generate the Standard Euros. It's pretty cool, actually. So we'll learn all about this today. Welcome to the show, Joshua.
Hey, thanks for having me back, Andy. It's good to be here.
Good to have you here, Joshua. So, look, let's do what we do, of course, at the beginning of the show. We'll invite you just to, introduce yourself, because you do have an interesting background, and of course, you're an Aussie. It's always good to have Aussies on the show. But just very briefly, please fill the listeners in on who you are and your background and the lead up to founding the Standard.
All right. Yeah. I've been in Bitcoin, working in Bitcoin mainly since 2010, and I found it so early because I was actually looking exactly for this sort of thing, because I was running a site where you could swap stuff instead of buying and selling, and realized pretty quickly that swapping is a terrible way of doing any transaction. Because you're stuck with one transaction when you've got a whole marketplace there. If I don't like anything of yours, then the deal falls through, and that's just it's a shame. So having some sort of currency in the middle actually is just such a beautiful thing. And it sounds stupid to say that now because it's very obvious, but when you're young and you think swapping's the future, I don't know. So I was looking for it, and it didn't exist, and but I did find what the cypherpunks were doing or trying to work on back then on their mailing list, and then sort of keeping up with what they were doing. I thought the double spend problem was unsolvable, like a lot of people did, and that's the problem where that Bitcoin really solved. Where I could send you an MP3 and you don't know if I still have a copy of it, and that's what Bitcoin really solved. I can send you now a Bitcoin, and I definitely don't have a copy of that Bitcoin anymore. So it's digital scarcity is what they really solved, and so. And then I've been sort of, when the white paper came across my table, I just fell in love and was working in that area. And I was warning people back in 2011 on YouTube saying, it's not a scam, it's not a tulip bubble. No one listened, but it's and ever since then, it's been a journey of all sorts of trials and tribulations. Losing money on Mt. Gox, the very first Bitcoin exchange that then went bust, and then building transparent. And then ever since then, I've been building. So I built a transparency protocol called the Glassbooks protocol for exchanges. Launched my own exchange in 2015 between Bitcoin and physical gold, because I didn't like, the banks. So why use the banks when we can use physical gold as a hedge? And then in sort of 2019, I gave a talk about stablecoins, because being in gold, you're kind of in the stablecoin area anyway. It's like a physical asset that can be insured to however much you've got, unlike a bank account. And it's relatively stable, right? Over 5,000 years, it's gone through every war and every nightmare that the human condition has thrown at it, and it's come through the other side being pretty stable. If there's a war in a country, most fiat just collapse. Well, all fiat just collapses pretty harshly. Whereas gold, if anyone's holding gold in those countries, it's still fine. But yeah, that's the the deep dive in me. And now I'm working on the next gen stablecoin protocol with a bunch of people around the world, and it's all about basing it on the gold standard, but a private gold standard. Like, we don't need to beg governments for a gold standard anymore. We can create a private gold standard that is in a decentralized way, and not just gold, but Bitcoin. And it's not the same as the gold standard, the traditional one, but it's got similar attributes, and we can talk about that if you want.
Sure thing, Joshua. And look, it's an interesting time to have you on, and it feels like, because you personally have a long-standing interest in both gold and Bitcoin, so you understand more than most the importance that gold's the role gold has played over the centuries as a kind of hedge against the wider economic turmoil, shall we say, and certainly in recent history, as you pointed out, when and kind of if a nation is in some form of crisis or war or something, then the local fiat currency does tend to become devalued very quickly, and gold, fantastic as a hedge. Of course, this year we're seeing this this potential banking crisis starting to unfold here in the West, really, particularly in Europe and, of course, in the US. And we've already seen gold hit an all-time high and then pulled back earlier this month. Bitcoin has done pretty well to start this year, almost up from, I think, 16,000 was the bottom back in November, almost double that to about, 28,000 here at the end of March. I guess it's just an interesting time in the world, Joshua. So I don't know if that just kind of sets the stage a little bit. Before we just dive deep into what the standard is, I'd love to kind of get your thoughts on that kind of, I guess, wider macro backdrop. What's going on with the banks?
Yeah, it's really interesting because we've, I said on Twitter about, I don't know, about a month ago. Well, it was just as a Silicon Valley bank, and well, maybe it was 2 weeks ago. I don't know. AI has sped up time and created weird loops now where I don't know what how quick time is.
So true.
But anyway, as Credit Suisse, I tweeted, who's next? Is it Deutsche Bank? And sure enough, 2 weeks later, Deutsche Bank's now talking. They're trying to sort of put lipstick on a pig, but it's really kind of, we're in a dangerous spot. And for the first time globally, we're seeing an inflation that is global. And this is very, very new. It's never happened before. Usually inflations happen within a country, and then it turns into a hyperinflation, and then the currency collapses and they reissue a new currency. But now, in a global setting where the US is printing like mad, we have the Fed's balance sheets is going massively up as well, and we're seeing other countries trying to keep up with the US to not be outprinted and devalued, and so like overvalued, against the US dollar. So there's so much happening that's really fascinating. And then on top of that, we have these massive technological bounds forward, and CBDCs. Everyone's talking about them in government, and nobody's talking about them on the ground as people. The normal folks are not talking about this very, very dangerous technology that they're just sort of putting out there as an upgrade rather than an absolute downgrade to freedom. And so the whole cryptocurrency space was really a pushback against digital, because everything was going digital anyway. We were going to get digital currency, and Satoshi front ran that idea by releasing Bitcoin when she did. And so, now that we have Bitcoin, we have this exit door, or we have digital currencies, we have this exit door from CBDCs. And that's all that I really want as me as a person. My personal view is, look, the government can do what they want. As long as they know that there's an exit door, it means that they have competition. It means that they cannot be ultimately corrupt and controlling, because if it's too controlled and too nightmarish, then people can just go, well, there's an exit door over there, I'm just going to take that.
Absolutely. And you have this quote on your website right, Joshua, and it's by Buckminster Fuller. So, I've always been a Buckminster Fuller fan. So as soon as I saw the quote, I was like, yep, this is great. The
Nice.
quote, of course, and it's a famous quote, so hopefully listeners will recognize the quote, but it is simply, you never change things by fighting the existing reality. To change something, build a new model that makes the existing model obsolete. And so in the terms of our in the context of our conversation today, Joshua, number one, obviously you couldn't ask for a better quote to describe, let's say, the potential of a Bitcoin, as a new system that changes reality and makes an existing model obsolete. So
we definitely saw that with the Occupy Wall Street movement, trying to fight the existing reality. They were there occupying for months on end, and all chanting in unison and whatever else they were doing. All useless. It's not going to do anything. It's just a big PR campaign. And usually what happens is then and we saw this with Black Lives Matter, some sort of company takes over and makes a hell of a lot of money and takes the original idea and frustrations of a grassroots movement and turns it into a profit-making machine, which then is just a brand. And this is exactly what happened with Occupy Wall Street, with Black Lives Matter, with these sorts of things where you do have a small grassroots frustration, and that just blows out into a big marketing machine. So Bitcoin coming along was actually, that quote was like, hey, we don't need to fight the existing set. We build something new. We build something better that is so much better that the old is just obsolete, and everyone will just gravitate towards that, and we just don't worry about it.
Absolutely. And I guess, you want to take this idea one step further, Joshua, and we're bringing it back to the standard, Joshua. So if Bitcoin is, an example of that new model that makes the existing model obsolete, what is the purpose of the standard? How do you guys take that a step further? And what is the standard? How is it a next generation monetary system?
Yeah. So if we look at Bitcoin, obviously the big things that people talk about there is in terms of a currency, it not really being the best currency because of the volatility. And so for me, as someone that has both feet firmly in the Bitcoin space, I don't really care about the volatility that much. But it's also because I've got in so early that I have enough profit to not worry that much about the volatility. But if we convince someone right now to sell their widgets for Bitcoin and then Bitcoin drops by 10%, they're going to not be able to restock, or, it just isn't good. So not only that, we've run an exchange since 2015, and it's Bitcoin only. So we had a lot of freelancers and people working for us, and they always invoiced us in Bitcoin and Ethereum. And in 2020, around about 2019, 2020, I just definitely noticed a firm and very strong move where all invoices started coming in stablecoins rather than Bitcoin or Ethereum. And whenever I queried that, it was always, well, my accountant's going to have a fit if I give them another one of these. So, stablecoins, and I'm seeing it now too. If I go to a conference and I want to pay for something, they're all asking for stable coins. And you got to think, why is that? Well, they have in one way, they have on the user perspective, they have the same functionality as crypto, right? It's kind of a bearer-based asset, unless you look at USDC, which can be confiscated, but we can talk about that. It's a bearer-based asset. It has the pretty much instant or 10-minute settlement, or 5-minute settlement that Bitcoin and all of these things, and it's programmable, right? So you can use it within DeFi. You can trade and swap between other interesting tokens, and if you invoice in that stuff, then you can trade it into the speculative asset that you want later without annoying your accountant. So it's just the natural way where people understand. And when I look through history, of like the German Deutschmark being brought over to the euro, what they had to do is value it at an easy calculation for the mainstream to even calculate it. So I think it was like everything is just double or something like that. I can't remember the exact exchange rate, but it was a very simple calculation. So people go, okay, it wasn't too bad. It wasn't too hard to sort of switch over. And I think stablecoins really make it easy for people to switch over because they know what something costs. They know how much, some bread costs in their local currency, but they don't know how many satoshis that bread is, and they don't want to do those calculations, and they don't want the volatility. So we need that functionality because the CBDCs are going to come in, and we can talk about why they are nightmares and why they're very dangerous if you want, but these are coming, and so we need something that has the equivalent nature of those, but have the decentralized nature, because we've seen experiments like Terra Luna fail. We've seen USDC now fail because of bank, and this is something I've been warning of at pretty much every conference that I talk at. I say these stable coins, these centralized ones, are very, very dangerous because we take crypto full circle back to fiat fractional reserve land. And so it's really important that we build a true decentralized cryptocurrency that is fully backed and collateralized and can't be, and transparent.
Yes, indeed, sure is. So, in summary, then I guess for listeners, the idea here, and I'm kind of pulling this from Joshua's website, but the idea is if, the context is around the world, there's trillions of dollars worth of assets and everything from precious metals to cryptocurrencies. And these are, effectively locked away in vaults or digital wallets, not doing too much, really. So one way of thinking about the standard is it's a stablecoin protocol or a next generation monetary system that can unlock this stored value. And the way that people do that is you lock up those assets that you already own as collateral in smart contracts, which I think on the standard are called smart vaults, and then against that collateral you issue this stable coin, which is based on the euro, I think, Joshua. So maybe just continue from there. And as I understand it, it's released on, I think you call it the initial bonding curve.
Yeah. I mean, so basically, if why we call it a monetary system, because it's a lending protocol at base level. This is, funnily enough, very interesting because the monetary system that we're in currently is also based on lending. So every dollar that you have in your pocket, or every New Zealand dollar, is somebody owes a dollar to the bank, to the central bank, for having that. And so it's issued by debt, but it's issued by debt with interest that doesn't exist. So most actual currency is issued through mortgages, and because that's the sort of the big money that floods into the market, and also business loans. But so everything is based on debt. Now, cryptocurrency like Bitcoin or gold is not lent into existence. It's found into existence. It's mined into existence. Someone finds those precious numbers in Bitcoin. They find one number and then they spend that into existence. Now, the reason why we're going back to lending for this is because we want, if we're going to use a currency, so there's a differentiation between money and currency. Money can be currency, but currency at its true form isn't really money. This is a weird thing here. I know most people sort of interchange those two, but currency is what you do is you back currency with money. You back currency with actual value. So
it's like hard. That's what people mean when they say hard money.
Yes, exactly. And Bitcoin is a type of hard money because they're a rare number that can't be duplicated, and there's a definite finite amount of these rare numbers. So the standard, what it is a lending protocol, but it's at 0%. So people say they've got some Bitcoin or some Ethereum, and they lock those up into a smart contract that they own the key. So we don't want to trust a bank like Silicon Valley Bank. We don't want to trust Celsius, which say they were sort of DeFi, CeFi, but basically you sent them your collateral and they speculated with it, and you borrowed some money from that. You don't want to trust these parties. You want to trust yourself, that you lock up something into a vault, you lock it, and nobody has access to that but you. Now, when you lock it, now that value that's locked, you can issue yourself up to 90% of that value as a stable cryptocurrency. Now we're starting with euro. We're starting with S euro, standard euro. But we're going to be issuing SUSD, S Indian rupee, S Aussie dollar, S New Zealand dollar, S British pound, all of them. So we have an FX blockchain mirror almost. And a lot of people will say, well, there's already protocols in DeFi that allow you to lock up assets and borrow against them. And they're right. But really, we looked at the best use cases and the worst, and we tried to find the perfect next generation version. So one of the things we found is that, okay, say you've locked up some assets, you've borrowed against them. Now, if those assets start to go down in value, they start to drop in value, you want the ability to not get liquidated as easily, right? That liquidation process happens. What that means is that you've got value. Let's say you got $1,000 locked up in a smart vault, and you borrowed $500 from that. If that smart vault drops to the value of $500, well, basically we need to take $500 dollars off the market, because we always want to have calculatable, more value locked up in the system, real value, than we want currency floating around. And so you liquidate those assets by people being able to buy them back, and with the S euro or S dollar that's floating around, and burning those S dollars. And they get that collateral out. I hope that makes sense. It's a bit complex, but basically the system needs to always have more assets locked up than stablecoins floating around. And so that to stop that liquidation process, you want to say, okay, you've got those assets locked up, you've got Bitcoin locked up, and Bitcoin's tanking like crazy because we're in a bear market. Let's swap that over to a tokenized gold. Within that, I know that you can't withdraw that Bitcoin until you've paid back that debt, but you can swap it for the same amount of value for something else. And so that's really one of the breakthroughs that we're doing, is to allow you to do that.
Yeah, so that does make sense, Joshua. So you're trying to make a kind of like a safer experience for people who want to perhaps use whatever they have on hand as collateral and access the liquidity there, hopefully without being liquidated. I did mention the initial bonding curve offering. Is that still how you I guess effectively achieve enough liquidity to launch each stablecoin and each of the fiat currencies, right?
Yeah, exactly. So what this does is build a liquidity pool. It's almost like a shared smart vault. So people will put in currency, like let's say ETH, into I should call ETH money, I guess, because it's rare now. It's actually it's in a deflationary period now, which is really interesting. But anyway, ETH or Bitcoin or one of these coins into that pool, and they will get S euro out at a discount while it's being launched. So it's not a stable coin yet at this time. It's at like 85 cents or something. And the more ETH that goes into this pool, the less that discount becomes. So the first people that put in ETH get a good deal on the S euro. And then as more and more liquidity comes in, that discount becomes less and less until it reaches a 1-to-1 peg. And at that stage, it becomes a stable coin. and we'll be releasing the smart vaults on around about the 27th of April. And that's when the S euro will become 1-to-1 and the bonding curve will stop. And so people that bought at a discount then, happy because it's gone up, and we're happy because they've helped us build liquidity into the mechanism of the system. And there's also, they can take that S euro in the meantime while they're waiting for the smart vaults. They can actually bond that with USDC or with DAI into a liquidity pool, and we buy that liquidity off of them, and that helps us over collateralize the protocol. It's super complex, but basically people buy it at a discount, and then they can take that S euro and put that with another currency like a pair onto Uniswap, and we'll buy the LP tokens off of them for the governance token. And so what that does is help us build these stability pools, which help us have the smart vaults at 0% interest. So the cool thing is, once these launch, we can really compete with the banks, because I've already had friends say, man, I'm going to trade my mortgage across to the Standard, because then I have a 0% mortgage. And I know that the stablecoin is stable because there's more liquidity backing, there's more actual value backing each S dollar than there is S dollars in the system. And some will say Maker has that ability because they are over collateralized. They were the original over collateralized stablecoin, but they made this weird decision to use USDC as a collateral type. And we saw it depeg because, Silicon Valley Bank went down, and USDC had $3.3 billion sitting in Silicon Valley Bank that was meant to be backing this, the USDC. So it's really a terrible idea. And I cannot wrap my head around why any protocol would allow a centralized stablecoin to be used as collateral for the same stablecoin. There's not even the upswing for doing that. You can't, like, if you put in ETH, the good thing is if you put in ETH or Bitcoin or even gold, you are long those, and you've borrowed money, you've got liquidity, you've bought your car, but you haven't sold your initial assets. So you hope that it'll go up in value. But doing that with USDC, it's not going to go up in value. In fact, it's going to go down with inflation. So it's really, really strange.
It is indeed really strange. Nicely said, Joshua. Thank you for that. I guess as we finish off this part of the podcast, tell us just a little bit about who the target audience is, I suppose, for the Standard. Who are you aiming at this at? And for people who are interested, where should they go? What should they do to get involved?
Yeah, so the original, the first target audience are like DeFi people, people that understand decentralized finance. They want to get loans. They want to maybe, take their Ethereum and buy more Ethereum with it, or they want to take their Ethereum and buy a car without selling their Ethereum. And the cool thing is that's not a taxable event then. You don't get capital gain tax because you haven't sold your crypto. You've just borrowed against it. And so there's all sorts of reasons why you would want to use something like this. But also once we go from there with the more technocratic crowd that understand DeFi, then we're going into the next circle out, which is the GameFi space, because I really see that as a huge boom in the next few years, where people will tokenize a lot of in-game items as NFTs, and then be able to, we want to be able to allow them, if it's liquid enough. It's really important, and the community decide, the governance system decides if something's liquid enough. But let's say there's a fairly common, I don't know, sword or whatever, it took you a while, and it's quite valuable. You could lock that up as collateral, and then borrow against that. These sorts of things are really interesting as well. But sort of that whole GameFi space. Imagine because we use a lot of tokenized gold in the Standard, people will be able to mine in-game tokenized gold, like real gold within games, and then be able to lock that up as a collateral type. So there's this sort of stuff. And then obviously the wider circle is building a true blockchain mirror of the FX market. Now, the FX market is the most liquid market in the world. So it's the one that's being traded the most out of everything. And so I think it's a huge boom for the Standard to, because we'll be issuing most major fiat currencies as stablecoins, to have trading pairs in between all of those on the blockchain. And so there's lots of stuff, but there's also an interesting crossover here with NFTs, and this is something we're really pioneering, is that if you take out debt from yourself as in this sort of collateralized debt position, you've put money in and you've borrowed against it. Let's say you bought a car and it's great, but you lose your job and you've got all this collateral locked in this smart vault and you cannot withdraw it until you pay back the debt. Well, what you could do in the Standard, what we've enabled is that every smart vault has an NFT as a key. And so that it's like a dynamic DeFi NFT. It's not an art NFT, although it has a nice piece of art attached to it, but it's mainly a key. So if you lose your job and you've got all this liquidity locked in and a debt, you can actually sell that debt with liquidity as an NFT on OpenSea to free up some more money for yourself. So it's it makes the whole DeFi space more liquid as well. And so these are also an interesting use case for and target audience is these sort of these sorts of instruments. Yeah.
Well, I mean, I think it would be super fun, Joshua, if I could perhaps, offer up my son's Fortnite skin collection as collateral to buy him a PlayStation 5. I think that'd be worthwhile. But thank you so much for sharing your thoughts with us today, Joshua. Please close it out. Take it away again. Tell people where they can go to learn all about what you and the team are building at the Standard. And look, if you've got a Twitter account or something like that, please, let us know.
Yeah, sure. My Twitter is @J, and then my last name, Scigala, SCIGALA, and so it's @JScigala, and the website is thestandard.io. We also run a Bitcoin physical gold exchange called Vaultoro.com that's been running since 2015 and never had a hack, and so that's also there for people, and it's that's the links.
Awesome. Thank you, Joshua. All the best and bye for now.
Cheers.
All right. There you go. That was Joshua from The Standard. Thanks for listening, everyone. This was the Crypto Conversation for Brave New Coin.